There's an old saying that three things destroy smart people: liquor, ladies, and leverage. The first two, they're just alliteration. The real killer has always been borrowed money. I am going to show you why leverage remains the most reliable way for intelligent people to turn fortunes into rubble. And I'll prove it with simple math, real examples, and some uncomfortable truths about human nature. Here's what you need to understand. A string of wonderful numbers multiplied by 0 always equals 0. It doesn't matter if you compounded at 20% annually for 30 years. Your IQ is irrelevant. Your track record means nothing. 1 0 eliminates everything, and leverage creates zeros. Without borrowed money, the worst outcome is losing what you invested. $100,000 in a stock that crashes means you lost $100,000. It's bad, but it's survivable. Your house remains, your savings exist. Recovery is possible. Borrowed money changes everything. A decline of any size can wipe you out completely when you're on margin, not just the investment, everything. Your broker forces you to sell at the worst possible moment. If the decline is severe enough, you end up owing more than you started with. Markets routinely drop 30, 40, 50% or more. Berkshire Hathaway stock, one of history's greatest investments, has declined over 50% on 4 separate occasions. If you'd used 2-to-1 margin, you'd have been wiped out 4 times. Every single time, the stock recovered to new highs. But none of that helps you when forced selling liquidated your position. This is the fundamental asymmetry. Gains are limited, but losses can exceed everything you own. Let me tell you about 16 of the smartest people ever assembled in one business. In 1994, John Meriwether founded Long-Term Capital Management. His team included 2 Nobel Prize winners in economics, Myron Scholes and Robert Merton, plus some of the most sophisticated minds on Wall Street. These 16 people probably had the highest average IQ of any group in American business. Collectively, they had 350 to 400 years of experience. Most had put virtually their entire net worth, hundreds of millions of dollars, into the fund. 4 years later, it collapsed. $4.6 billion vanished in under 4 months. The Federal Reserve had to coordinate a $3.6 billion bailout to prevent a systemic collapse. How they operated at 25-to-1 leverage, $125 billion in assets on $5 billion in equity. When Russia defaulted and markets moved against them, their positions collapsed faster than they could exit. These weren't fools or conmen. They were legitimate geniuses who understood risk management better than almost anyone, and they still blew up. Leverage doesn't care about your IQ or your credentials. The only thing that matters is whether you can meet margin calls when markets move against you. And markets will move against you at the worst possible time, in ways you didn't anticipate, for longer than you can remain solvent. The lesson: to make money they didn't have and didn't need, they risked what they did have and did need. That's foolish. Your IQ doesn't change that equation. You'd think Wall Street learned something from that. You would be wrong. March 2021, Bill Wang lost $20 billion in 2 days. His fund, Archegos Capital, had been using 5-to-1 leverage through total return swaps. $20 billion gone in 48 hours? The banks enabling this, Credit Suisse, lost $5.5 billion. What makes this fascinating is that the prime brokers knew they were dealing with a reckless client, and they were getting paid handsomely for it. The lure of easy fees overwhelmed their risk management. This is a recurring pattern. The people enabling leverage understand the risks better than those using it, but they do it anyway because short-term profits are irresistible. The fees get collected today, the catastrophe happens later, on someone else's watch. Before the 1929 crash, investors could buy stocks on 10% margin, put down $10, borrow $90, and buy $100 worth of stock. A 10% decline wiped out your entire investment. A 20% decline meant you owed money you didn't have. When prices started falling, margin calls cascaded into forced selling, causing further drops, which triggered more margin calls. The spiral fed on itself until the market collapsed entirely. This wasn't panic, this was arithmetic playing out exactly as the numbers demanded. After hearings in 1932, lawmakers recognized that excessive leverage caused the catastrophe. The Federal Reserve received authority to set margin requirements and used it 23 times between 1934 and 1974 to prevent leverage from building up. But memories fade, regulations weaken, new instruments circumvent old rules. Every generation relearns the same lesson the hard way. This isn't just about hedge funds. Leverage destroys ordinary people just as effectively. Consider the typical household. Spend a little less than you earn. You accumulate wealth. Spend a little more. You've got detanned. Chances are you'll never get out. Someone earning $50,000 who spends $48,000 builds wealth slowly but surely. Someone earning $50,000 who spends $52,000 digs a hole that gets deeper every single year. 18% credit card interest makes getting ahead impossible. You're compounding in the wrong direction. The same force that builds fortunes is now working against you 24/7. The math is brutal. $10,000 at 18% interest with minimum payments means you'll pay approximately $30,000 over 25 years. You bought something for 10 grand and paid 30 grand for it. Run it the other way. That same $10,000 invested at 8% for 25 years grows to nearly $70,000. The difference isn't $20,000, it's closer to $100,000 over a lifetime. And that's from one single $10,000 decision. If leverage is so dangerous, why do intelligent people keep using it? It comes down to human psychology. We overweight potential gains and underweight potential losses. We believe we can time our exit. We see others succeeding with leverage and think we can too. Most importantly, we confuse recent experience with permanent truth. Markets going up for 10 years. We assume they'll continue, so we leverage up because it seems safe. Then the trend changes. Envy creates problems. Your neighbor appears to get rich faster because he's using leverage. The thought creeps in, why am I being so conservative? This is backward thinking. The question isn't how much more you could make. The question is, what happens if you're wrong? If you're already comfortable, using leverage is crazy. The incremental value of extra return isn't that great when you have enough. But the cost of catastrophic loss? Enormous. You're risking everything to gain a little more. The upside is limited. The downside is unlimited. Now, not all leverage carries the same risk. The key distinction is callable versus non-callable leverage. Insurance float works because it can't be called during a market downturn. Nobody demands you pay it back tomorrow because the stock market fell. A fixed-rate mortgage works similarly. The bank can't demand immediate repayment when house prices drop. You have decades to pay it off. The danger lives in leverage where someone else controls when you have to pay. That's when smart people go broke. That's when forced selling at the bottom wipes out years of gains. Instead of asking how to get rich, ask how to go broke then. Just avoid those things. Smart people go broke by using leverage. They don't need to chase returns. They do require confusing a bull market with personal genius. Assuming the future will look like the recent past, believing they can time their exit, thinking they're smarter than the market, and failing to imagine what happens if they're wrong. Write down that list. Read it every time you're tempted to do something clever with borrowed money. Here's the simple arithmetic that proves patience beats leverage. 8% annually with uninterrupted compounding transforms $100,000 into $215,000 in 10 years. 20 years, $460,000. 30 years, over $1 million. You didn't do anything clever, you just let time work. The alternative, you use leverage to chase 15% returns. It grows faster initially, but inevitably, over 30 years, you experience a drawdown that triggers a margin call. Forced selling follows. You lose everything. The patient investor at 8% for 30 years has over $1 million. The leveraged investor who earned 15% for 15 years then blew up, has nothing. 0 times any number is 0. The goal of investing isn't to maximize returns in any single year. It's to be around for the long term. To let compounding work, to avoid the zeros that eliminate everything you've built. You cannot compound from 0. Don't interrupt compounding. Don't take catastrophic risks. And don't borrow money to buy things that can decline in value. The advantage isn't brilliance. The advantage is avoiding stupidity. And avoiding stupidity consistently, over decades, is more than enough to build wealth that lasts. Thanks for watching.